Are you dreaming of buying your own home but struggling to come up with a down payment? Or maybe you're a homeowner wishing you could get cash out of your property but you're just unable to afford higher monthly payments. Well, what if I told you you could get 6 figures of cash with no additional monthly payment? Too good to be true? Nah, I did it. And let me show you how you can do it too.
Welcome to Rock Real Estate with Stu Simone, where we make real estate informative and fun. And now, here's your associate broker, real estate attorney, and mortgage loan originator, Stu Simone.
Welcome to Rock Real Estate, where we bring you the latest trends and insights in the world of finance and real estate. I'm Stu Simone. Today, we're diving into the concept of shared equity lending, also known as co-investing. And we're also going to introduce you to the top companies in this cutting-edge industry. Co-investing is a fiendishly clever and unique financial arrangement where a financial institution becomes both your lender and your investor in the property. You can get a boatload of cash without having to pay it back by the month. Say what? All right, let's break it down. First, the concept. While it's often called a shared equity mortgage, it's not like any loan you've ever had. In fact, I don't consider it a loan at all. To me, it's more like having a real estate investor buy a portion of your property. They give you purchase money, but the difference is they don't take a piece of your title. They have a lien. I'll put it a different way. The property owner agrees to sell a percentage of their property's future gain from appreciation to the lender in exchange for cash now. Homeowners can basically get a cash out refi without increasing their monthly bills. And buyers can use this to provide down payment assistance if needed. Here's an example. Jim wants to buy a property that costs $500,000 and everything looks good except he's short on the down payment. Finds a shared equity investment company willing to lend him $100,000, which completes his down payment, and in this case allows him to avoid PMI. In Jim's case, the shared equity company sets the agreement length at 30 years. This means he won't have to make any repayments on the amount until he sells the home or 30 years have passed, whichever comes first. This way it's similar to a reverse mortgage. Now, at the end of the agreement, Jim will repay the initial investment plus a percentage of the property's gain or loss over the span of the agreement. Let's say their term is 35% of the gain. Now let's fast forward 15 years. Jim is ready to sell his home. Depending on how the value of his home has changed, different scenarios unfold for the repayment. So if the value is increased to $650,000, Jim will owe the lender the initial investment of $100,000 plus 35% of the $150,000 gain, which amounts to $52,500. So his total payment would be $152,500. But what if the value of Jim's home remained the same? In that case, he would owe the lender the initial investment of $100,000 and nothing more. And finally, if the home's value dropped to $450,000, Jim would only need to repay the difference between the initial investment, $100,000, and the investor's percentage of the loss, which in this case is 35% of minus $50,000, resulting in a total repayment of only $82,500. That's crazy, huh? So he actually got $100,000 and only had to pay back $82,500. As you can see, shared equity agreements offer flexibility and can be a great option for those who need down payment assistance or want to access their home's equity without taking on additional debt. And shared equity mortgages can also help borrowers reduce monthly mortgage payments and avoid costly fees like private mortgage insurance. And to me, it seems like the lender investor is taking on more risk than the traditional lender, as they are banking on your property appreciating. A number of private investors and municipal governments are using this model to offer down payment assistance to qualified buyers, making homeownership more accessible. Shared equity lending offers an alternative approach to traditional mortgage financing, providing opportunities to individuals to overcome down payment challenges or access home equity without taking on additional debt. Sounds amazing, huh? However, it is crucial to thoroughly understand the terms and implications of any shared equity agreement before committing. If you're considering a shared equity agreement, here are some terms to consider when comparing different options. Equity percentage. Determine the percentage of equity the investor will take in your property. This will affect the amount you owe them when you sell the home and the amount you get. Compare different offers to see which arrangement works best for you. Agreement length. Understand the length of the shared equity agreement. Shorter agreements mean you'll need to repay the investor sooner, while longer agreements provide more time but may result in higher repayment amounts due to the property value appreciation. over time. Repayment terms. Examine the repayment terms carefully. Some agreements require a fixed repayment amount, while others calculate the repayment based on a percentage of the property's gain or loss, as in that example. Consider which option aligns with your financial goals and risk tolerance. Future sale considerations. Assess how the shared equity agreement will impact your future home sale. Determine if the investor has any rights or involvement in the sale process, such as priority repayment or decision-making power. Future refinance considerations. The shared equity lender will have a junior lien on your property. If you refinance, your new first lien lender will not approve of the transaction without receiving a subordination agreement from the shared equity lender. Flexibility and portability. Evaluate the flexibility and portability of the shared equity agreement. Can you transfer the agreement to another property if you decide to move? Well, that'd be cool. Is there an option to buy out the investor's share before selling the property? That'd be nice too. Costs and fees. Understand any costs and fees associated with a shared equity agreement. This may include administrative fees, legal fees, or other charges. Compare the total costs across different options to ensure you're getting the most favorable terms. You're always going to have some little fee or else they may not make any money. Future market considerations. Consider potential market fluctuations and their impact on your repayment. If the housing market experiences a downturn, you may owe the investor a percentage of the loss, but conversely, a strong market could lead to higher repayment amounts. Next, we will be discussing the best shared appreciation mortgage companies of 2023, according to leading financial analyst Investopedia. Our first category is Best Overall, and the winner is Unison at unison.com. Full disclosure, I got about $100,000 in cash from Unison about 10 years ago and used it to purchase an investment property. Unison offers a 30-year term length up to $500,000 in cash and a pre-qualification process with no impact on your credit score. So let's take a closer look at Unison's pros and cons. Unison's advantages include a maximum term of 30 years with the option to buy out Unison's claim at any time. Most importantly, your cash out comes to you with no added debt, no monthly payments, and no interest. Amazing! Homeowners can convert up to 17.5% to a maximum of $500,000 of the home's value to cash if there's equity built up, and there's no minimum income or age requirements. On the downside, if the property significantly appreciates, you'll pay more to Unison. After 30 years, homeowners are responsible for either buying out Unison or selling the house. It's important to note that if the home is not properly maintained, the amount to Unison could increase. And additionally, there's a transaction fee, of course, of 3%. Unison is our top pick for best overall because of its long 30-year term, high cash payouts, and straightforward eligibility and funding process. Next up, we have the category for best long terms, and the winner is Point at home.point.com. Point gives you 30 years to decide when it's best for you to pay back the company, and they can also invest up to $500,000 depending on how much equity you have. So let's explore Point's pros and cons. Point's advantages include no monthly payments, investment amounts available up to $500,000, homeowners retaining control, and Point not being added to the title of your property. However, there are some considerations. Homeowners could end up paying more if the home appreciates significantly over 30 years, and Point uses a risk-adjusted home value of 15 to 20% less than what your home appraises for. Also, there's no access to ongoing cash since Point provides a one-time lump sum payment when investing in the equity of the home. Currently, Point is available in 26 states, including select regions of California. Point is our top choice for long terms because it offers a 30-year repayment option and a simple online quote process with substantial funding available. Next, we have a category for best for fair credit, and the winner is HomeTap at hometap.com. So if you have a FICO score down there in the 500s, HomeTap is an alternative financial solution definitely worth exploring. They permit a high loan-to-value ratio of 75% and provide funds up to $600,000. So let's take a closer look at HomeTap's pros and cons. HomeTap's advantages include no payments until you sell your home or settle the investment term, eligibility for single-family homes and condos, a loan-to-value ratio of up to 75%, and funds, as I said, up to $600,000. But on the flip side, the investment maximum effective period is only 10 years, and HomeTap is currently investing homes in only 15 states. HomeTap is our top pick for homeowners with fair credit scores because they can work with a FICO score as low as 500 and provide significant funds with a high loan-to-value ratio. Also, honorable mention goes to Unlock at welcome.unlock.com for best for buyout flexibility. Now, Investopedia gave NOAA Best Homeowner Protection Program, but I checked NOAA at noaa.co and found their site to be closed, except for this passage. Please be advised that servicing matters for your agreement have been transferred to another company. Kindly check your email for additional details and contact the new servicer going forward for agreement-related matters such as account information, lien subordinations, property sales, option terminations, etc. Well, this brings up an interesting issue. Is this too good to be true? Perhaps it is. After all, these companies' lives depend on the fact that real estate will always appreciate and never go down for long. Well, as you know, after the great market crash of 2008, it took the better part of a decade for real estate prices to fully rebound. What if something like that happened again? Would these companies be able to stay afloat? 2 years ago, I was a little worried that Unison was going under. As I was trying to get a 3% refinance at the time, and I had to get a subordination agreement from Unison to make it happen, and it took quite some time to finally get a hold of someone there. Now, here's an interesting question to ponder. What if the company did go under? Would you ever have to pay the money back in 30 years? Okay, well that wraps up our discussion of the best shared appreciation mortgage companies of 2023, at least according to Investopedia. All of these companies offer attractive opportunities to access your home equity without the burden of additional debt, and I would apply to each and every one of them. Now remember, it's essential to thoroughly research and consider the pros and cons of each company and program to find the one program that aligns with your specific needs and goals. And if necessary, consult with a qualified financial advisor to guide you through this decision-making process, because this is different stuff. This is new stuff. In conclusion, every shared equity arrangement is unique, so take the time to compare offers, ask questions, and ensure that it aligns with your financial objectives and personal circumstance. But you have to admit, it's pretty damn cool to drop 100 G's in your bank account and not have to pay a penny for possibly as long as 30 years, right? All right. Well, that's all for today's discussion on shared equity lending. We hope this information helps you make informed decisions about your real estate adventures. As always, stay tuned for more insights and updates in the world of real estate and finance right here at Stu Simone's Rock Real Estate. Thanks for watching and stick around for the next video.